$900. That's it. That's the number standing between where you are right now and where the story ends, which is over $1,000 a month in passive income, arriving whether you work or not. I'm not going to sell you anything. I'm not going to hype this up. I'm just going to show you the math, walk you through exactly how it works, and let you decide what to do with it. Because here's what that $900 actually represents. 3 months of skipping one daily coffee run. 1 month of canceling streaming subscriptions you forgot you had. It's not a sacrifice, it's a trade. You hand over something small, and in return you buy yourself a system that pays you back, forever. Most people never start because they think they need more. They're waiting for the right moment, the right amount, the right market. And every year they wait, they lose compounding time they can never get back. A 25-year-old putting $100 a month into the market reaches roughly $584,000 by age 65. A 35-year-old doing the exact same thing, same $100 a month, only gets to $217,000. Same discipline. Same money. A $367,000 gap. Just from waiting 10 years. That's not opinion, that's arithmetic. So let's stop waiting. Let's talk about dividend investing. What it is, why it's the most beginner-friendly wealth-building path available right now, and exactly how to turn $900 into something that rewires your financial life. Here's something that should bother you. In 2025, 62% of Americans own stock. But among households earning under $50,000 a year, the people who need compounding the most, that number drops to just 28%. The wealth gap in this country isn't just about income. It's about who knows how the system works and who doesn't. Dividend investing is one of the cleanest on-ramps into that system, and it starts with understanding one simple idea. Companies make money. Some of them share that money with shareholders, the people who own even a single share of stock. That payment is called a dividend. You own a piece of the business. The business pays you. That's it. You don't have to sell anything. You don't have to time the market. You just hold, collect, and, if you're smart about it, reinvest. So what does $900 actually buy you today? At the time this script was written, SHD, the Schwab US Dividend Equity ETF, trades at around $31.12 per share. $900 gets you roughly 28 to 29 shares. SHD carries a 3.40% dividend yield, a 0.06% expense ratio, and $87 billion in assets under management. That expense ratio is nearly zero. You're keeping almost every dollar your money earns. Now, 3.4% on $900 is about $30 a year. I know, sounds like nothing. That's the part most beginners see and walk away from. But they're looking at the snapshot. They're not looking at the movie. Here's the movie. SHD has grown its dividend at 10.72% annually over the last 10 years. Over the last 5, that rate is 9.22%. So the dividend you receive isn't fixed. It grows, year after year. And when you pair that growing dividend with something called DRIP, Dividend Reinvestment Plan, the math starts doing things that feel almost unreasonable. DRIP means your dividends don't hit your account as cash. They automatically buy more shares. Fractional shares even. Every dollar your portfolio pays you gets immediately put back to work, buying more of the same ETF, which pays more dividends, which buy even more shares. It's a loop, a self-reinforcing loop, that accelerates the longer you leave it alone. Here's a number that makes this concrete. $10,000 invested with DRIP enabled grows to $194,161 over 20 years. The same $10,000 without DRIP, where you just pocket the dividends and don't reinvest, grows to $90,220. Same investment, same time horizon. A 115% gap, just from turning one feature on. So let's run the actual numbers on your $900. You start with $900 in SHD, you turn DRIP on, and you commit to adding $100 a month, less than most people spend on subscriptions they never use. At a 12% annual return, which sits within SHD's historical range when you factor in dividend growth and price appreciation combined, here's what happens. Year 10, somewhere between $23,000 and $25,000. Year 30, somewhere between $320,000 and $360,000. you're generating roughly $12,240 a year in dividends. That's about $1,020 a month, coming in whether you go to work or not. From a $900 starting point and $100 a month. That's the movie. Now let's talk about the actual investments. Because SHD is not your only option, and depending on where you are in life, a different tool might fit better. SHD is the foundation. It holds around 100 high-quality U.S. dividend stocks, companies with long records of paying and growing their dividends. It's not flashy. It's not going to give you a 50% year. What it gives you is consistency, low cost, and a dividend that grows over time. For a beginner with a 20 to 30-year horizon, SHD is about as close to a set-it-and-let-it compound position as you can find. But let's say you want income right now. You're not 25, maybe you're 45, or 50, and you want dividends that actually show up as real money in the near term. That's where JEPI comes in. JEPI, the JP Morgan Equity Premium Income ETF, currently yields around 8.26% and pays monthly. It gets that yield through a strategy called a covered call overlay, where the fund sells options contracts on top of its stock holdings to generate additional premium income. The trade-off is that you give up some upside in a roaring bull market in exchange for a fat, steady monthly payment. For an investor who needs income now, rather than in 30 years, JEPI has a real role to play. Then there's VYM, Vanguard's High Dividend Yield ETF. Yield sits at 2.26%, which is lower, but you get exposure to over 500 dividend-paying stocks, a rock-bottom 0.04% expense ratio, and in 2025, 100% of its dividends qualified as qualified dividends, meaning they're taxed at the lower capital gains rate rather than ordinary income. Broad diversification, minimal cost, tax efficient. VYM is the kind of holding that quietly does its job while you're not looking. And if you want a single stock instead of a fund, look at Realty Income, ticker O. It's a real estate investment trust that owns over 15,000 commercial properties. The current yield is 5.8%. It pays 27 cents per share every single month, and it has raised its dividend 113 consecutive quarters in a row. That's over 28 years of consecutive dividend hikes without missing a beat. They call themselves the Monthly Dividend Company, and they've earned it. Now, before you start buying any of these, there are 4 concepts every beginner needs to understand. Get these wrong and you'll make the mistakes that kill returns before compounding ever gets a chance to work. First, dividend yield. It sounds complicated. It isn't. Yield is just the annual dividend divided by the share price. SHD pays about $1.06 per share per year. The share price is $31.12. Divide one by the other, and you get 3.4%. That's the yield. Higher price, lower yield. Lower price, higher yield. Simple. Second, payout ratio. This is the percentage of a company's earnings that get paid out as dividends. A payout ratio in the 40% to 60% range is healthy. The company is sharing profits while keeping enough to grow the business. A payout ratio above 80% is a yellow flag. A payout ratio above 100% means the company is paying out more than it earns, borrowing against the future to fund the dividend. That dividend is living on borrowed time. Third, the ex-dividend date. This is the cutoff date. You must own shares before this date to receive the next dividend payment. Buy the day after, and you miss it. Also worth knowing, stock prices typically drop by roughly the dividend amount on the ex-dividend date because new buyers won't receive that payment. It's not a trick, it's just how the math balances. Fourth, DRIP. You already know this one. Turn it on and never turn it off, at least not during your accumulation years. Here's where beginners go wrong, because this is where most people lose money before they've even given compounding a real chance. Mistake number 1 is chasing yield. You see a stock with a 12% dividend yield and think you've found easy money. What you've actually found is a company the market has already priced for trouble. When a stock's price drops far enough, the yield gets distorted upward, and the market is usually pricing in the fact that the dividend is about to get cut. A 12% yield is almost always a warning sign, not an opportunity. SHD at 3.4% might not excite you, but it'll still be paying 10 years from now. Mistake number 2 is ignoring the payout ratio. A 95% payout ratio leaves zero cushion. One bad quarter and that dividend disappears. Always check what a company is actually earning before you decide the yield is safe. Mistake number 3 is going all in on one stock, one company, one dividend, one point of failure. ETFs solve this problem instantly. SHD holds about 100 stocks. VYM holds over 500. Even if 5 or 10 of those companies cut their dividends in a rough year, the overall fund barely flinches. Mistake number 4 is not using DRIP. You receive a dividend. You leave it as cash. You tell yourself you'll reinvest it later. Later never comes. Meanwhile, that cash sits idle and the compounding loop breaks. DRIP automates the decision, so you never have to make it. Mistake number 5, and this one costs people real money, is forgetting taxes. Dividends inside a regular taxable brokerage account are taxable in the year you receive them. Even if you reinvest through DRIP, you'll owe taxes on what the fund paid out. But if you hold SHD or JEPI inside a Roth IRA, every single dividend is completely tax-free. Forever. You contribute after-tax dollars once, and every dollar of growth and income from that point forward belongs entirely to you. For a beginner, getting your dividend ETFs inside a Roth IRA before anything else is one of the highest impact moves you can make. Mistake number 6 is timing the market, waiting for prices to drop, waiting for a crash, waiting for certainty that will never come. The investors who consistently beat the timers are the ones who simply stayed in. Every month you're on the sideline, SHD is paying dividends to the people who aren't. Now I want to take a second and address the thing that trips most beginners up before they ever hit buy. They think they need more money to start. You don't. Fidelity, Schwab, and Robinhood all offer fractional share investing starting at $1. If you have $23, you can own a piece of SHD today. Every dollar you put in is a dollar that starts working immediately. You don't need to wait until you can afford a full share. You don't need to wait for your next paycheck. You need to start. $900 is a real number. It's 3 months of skipping a daily coffee. It's 1 month of cutting the streaming services you haven't opened in weeks. It's not a sacrifice, it's a trade. You give up something small and forgettable, and in return you buy yourself the first position in a machine that generates income for the rest of your life. The wealthiest people in this country aren't wealthy because they earn more. Most of them are wealthy because they built systems that generate income without requiring their time. Dividends are one of the simplest versions of that system available to a regular person with $900 and a brokerage account. You now know the math. You know the ETFs. You know what DRIP does. You know what payout ratio to watch for. You know the 6 mistakes and exactly how to avoid them. The next question is just whether you actually do something with it. So tell me in the comments, what's stopping you? Is it that you feel like $900 isn't enough? Is it that the market feels too unpredictable right now? I want to know the real answer, because I'll guarantee someone else in this community has the exact same hesitation and they need to hear your honest answer just as much as mine. If this shifted how you think about building income, hit the like button. It genuinely helps more people find this. Share it with someone who's sitting on cash they don't know what to do with. And subscribe if you haven't, because next week we're getting into something that most dividend investors completely ignore, and it quietly adds thousands of dollars to your long-term returns without changing a single holding. The $900 is just the beginning. The question is what you do with it today.